What's up, man?
Going on? How you doing?
I'm good. I'm excited to talk about taxes and money and investing and all that. I all that stuff. I consider myself pretty expert on investing and whatnot. When it comes to taxes, I don't know. I just have this like visceral angsty feeling. I was just talking about it briefly before you came on.
Yeah,
So I'm dying to get into it all. Why don't you tell people a little bit about yourself and your journey to get here and what you're trying to do with the world?
sure. Yeah, so I'm a CPA, certified public accountant, primarily focused on the tax side. Basically, help business owners and as many people as I can pay as little taxes legally possible and understand the numbers and finances side of their business. Most people, when they start a business, they're really good at doing the thing they do, and they have an entrepreneurial seizure. And then they go do that thing in a new business. They don't know the number side. They don't know any of that. So I'm here to educate them as best I can. So I've had my own firm for gosh, I don't know, 5 or 6 years now. Been doing it for 10 or 11 years. But my dad started his first firm when I was 3 months old, so I really grew up in the business. Hearing him talk about taxes with his ski trip on ski trips with his buddies who were also clients. Business partners with Tony Robbins, for everyone who knows who that is, the personal development teacher, coach. And so I've had the opportunity to speak on stage at his business mastery events. And we're one of two firms in in the United States portion of his Global Accounting Advisors program. We got connected over Instagram here, and I do a lot of tax tips on Instagram, and kind of that's about 160 seconds is about all anyone can stand around taxes. And so I think Instagram's been a nice platform for me to be able to kind of teach it in digestible chunks.
I think most people have this like aversion to it. At the same time, I don't think there's one person, if you ask them, would you want to learn more and understand your taxes better to save more money, that would say no, right? So it's like
Right.
this. So yeah, we're going to talk a little bit more than 1 minute about it, and I'm excited, and we'll try to keep it lively and interesting. You've got a bad rap, your job description, right? People, I think, have a negative connotation with it, just in general, just in terms of like, oh, I'm not a numbers guy. His brain works differently than me, and that stuff I don't understand. So, but
Yeah.
it really is fascinating stuff. And, you can't just rely on, I don't know if you were on when I said this, you can't just always rely on your current accountant or the advice you get from your wealth advisor or whatever, because, it's like having a good shrink, in my opinion. It can totally screw you up, screw your head up, screw your wallet up if you're not, doing the right things and taking the right action. So, let's just dive right into it. Let's get into so like what would you say are some of the top pieces of advice that you would give to people like me that kind of have this aversion? I have an accountant. I kind of trust him. I don't really know much what's going on, and I just sort of get the thing in the mail and I sign the check and I send it
Yeah.
in.
Yeah, it's funny. Right when I logged on, you were talking about how you like most people hate doing your taxes. Like when the word tax comes up, it's just like a cringe moment. And I actually wrote an article in Forbes on 3 ways how to not hate tax time. And one of those is most people think that the time of year to meet with your CPA is February, March. It's tax season. You see the big TurboTax ads at the Super Bowl and it's time. It's the time to gather all your shoebox of death, gather all your tax documents, dump them on your accountant's desk, and then they fill out some forms and tell you what you owe and how well you did or didn't do last year. What you want to do to make us a profit center for you is meet before year end. So as kind of sometime between late October and early December, so that we're close enough to the end of the year where we have a clear picture of what we think the full year is going to look like, but enough time before year end to, if there's any new strategies or new laws, we can enact any action items to lower your tax bill. So we meet last couple months of the year, run your numbers and say, okay, if you did nothing and we didn't talk, you would owe X. Let's do 1, 2, 3, 4 action items. Maybe we form a new entity. Maybe you've got kids under 18 and we get them on the payroll to save $12,000 per year of tax-free income. Do these items and then your tax bill is Y. So you lower it by 10, 20. We have had sometimes where we've saved clients $4 or $5 million from that meeting. That's the best way to actually enjoy, because paying your taxes is no fun, but saving thousands gets pretty sexy. And
for sure.
the other part is, if you know in December what you're going to owe on April 15th, it allows you to prepare for that. It gives you a few months to save up what the tax bill is going to be on April 15th. Because I know most people, and when I first started getting into this business, 80 to 90% of the clients would come in and they would only meet with us that one time a year. And those were the 2 weeks that we had their return in our office was like the two most stressful weeks for them, because they don't know if they're going to owe $50,000, if they're going to get a $10,000 refund. So if you know in December what you're going to owe in April, a lot of stress comes from the unknown. So even if it's a lot of money, if you know it's going to be that amount, you can prepare for it and eliminate that unknown. So
yeah, that's a great point.
That's one of them. And then the other thing I would say that not enough business owners do is keep current on their bookkeeping throughout the year. Most people just they do that they get their shoebox at tax time and dump it on the accountant's desk, and then they catch up all their records. They're not using it to make decisions in their business.
Right.
And then when it comes to tax time, they've got this mountain of work because they've got to do a whole year's worth of accounting. So number one, they don't know what they're going to owe. Number two, it's this huge chore. And so that's why everybody hates tax time. So if you can keep, whether it's, you're not going to do it, so you hire a bookkeeper to do it for you, or you just take 5 minutes a day, link up your bank accounts and import your transactions so that you're staying up, while you're having your morning coffee, and get that uncomfortable, painful part out of the way early in the day. So I say it's easier by the bottle than by the keg. So, it's just doing it throughout the year is a better way to do it. So
yes. Yeah, I totally agree. So I think you kind of went through three things. One thing we're trying to do on the show now is, so obviously that those could not have been answered in 1 minute, but what I'd like you to try to do is just summarize it all. I think those are three main points. Just kind of summarize those, because what we do is, now that reels are becoming, so popular and short, that we're trying to do more little 1 minute clips, and that way I can kind of go, I can have the question I ask up on the screen, and then boom, you go right in.
I like
so. You want to just summarize those real quick, and I'm sure it'll help listeners already that just heard that as well.
I mean, it takes, when we bring new accountants on, it takes a handful of times explaining it for it to grasp. So
no doubt.
Number one, to hate tax time less, you want to not meet in February, March. You want to meet before year end so that you can run numbers, know what you're going to owe, and get a list of action items from your accountant to do X, Y, Z and lower your tax bill by $10,000, $20,000, $30,000. Because if we're meeting after the clock strikes midnight on December 31st and Ryan Seacrest wishes everyone a happy new year in Times Square, there's nothing we can do to lower your tax bill at that point except for tell you to max out your IRA. So
love it.
That's one. Two, it's easier to do your bookkeeping throughout the year than it is to wait until tax time and collect your shoebox of death of receipts and print out a full year's worth of bank statements and credit cards. That's why people hate tax time, because they make it an annual chore rather than a daily habit. And so keep your business books up to date. And this goes for your personal books as well, on a regular basis. And that will allow you to not hate tax time. It will also allow you to make better decisions in your business because you'll know your numbers.
Totally. Love it. I think that was under a minute. That was pretty darn good. If not, it's close, and we can do like a part one and part two.
Yeah.
Nice work. So, okay. So kind of going beyond that, getting into more specific type stuff, do you advise people on the different loopholes? And I mean, I assume that you have a very vast knowledge of, the types of ways that people can save on taxes that they're probably not even aware of. And are there certain ones that stand out to you that a lot of people are pretty obvious to you, but a lot of people tend to look over and miss?
Yeah, there's a couple really, really easy ones that are simple and everyone loves, but they don't always do. One is known as the Augusta rule. And it's a rule that says if you own your home, you can rent it up to 2 weeks a year tax-free. And it was named the Augusta rule because in Augusta, Georgia, every year when the Master Golf Tournament comes into town, the residents clear out and they rent their home out for a pretty penny. So what you can do and how you can use this in your business is once a month you hold a shareholder board meeting at your house and you rent it out to your business for the use of the house. Now you have to have a business location outside of your home, but if your home's worth $500,000, let's say, you do a monthly shareholder board meeting for $500 a month. Cut a check, 14 meetings per year. Deductible as rent expense to your business and tax-free to you.
Oh, that's a great one. I've never heard of that. I love that.
So if you're renting, so the two criteria are you've got to own your home to do it, and you've got to have a business outside of the house. I guess three criteria. And you have to have an actual entity. So an S corporation or an LLC, you can't just be a sole proprietorship, because if you are just a sole proprietorship, your business is you, so you don't have an entity to rent it to. So there's everything's a deduction until you get audited. We want to make things the right way, where if you get it audited, it holds up.
Okay, I like that. What else you got? Any others that stand out?
The next one is the right entity selection. And I mentioned S corporation. So, once you hit about $60,000 or $70,000 a year in net income, and there's a couple states where this doesn't work, but in almost every state in the union, you want to look at forming an S corporation and operating your business as an S corporation. And you can save up to $13,000 a year by forming an S corporation. And essentially what you're doing is saving self-employment tax. And what self-employment tax is it's your portion of Social Security and Medicare as a self-employed individual. So when you're a W-2 working for the man and you get a paycheck, there's an amount on your pay stub that says Social Security and Medicare. That's about 7.5% of your pay. Then your employer matches that and sends 15% to the IRS in the form of payroll taxes. Well, when you're self-employed, there's no one to withhold that 7.5%. There's also no one to match it. But of course, the IRS still wants their 15%. And so by forming an S corporation, you can mitigate that and significantly lower it, without going into all the details. That's something that I would really want to look at once you hit about 60 to 70,000 net income.
I have an S corp. S corps are. I'm all about this. Love it. Thank you. Yeah.
The right reasonable salary, because a lot of people think that they need to have the salary in the S corporation that they need to live off of. And what you want to do actually is have the lowest justifiable wage as possible, because the way that Social Security works is on everything above about $45,000 in wage, only 15% of the Social Security tax you pay is going into your retirement bucket, whether that's even going to be around when we pay. So you break even on Social Security around a $40,000 salary. So just because you pay yourself a $40,000 salary doesn't mean that you have to live off of $40,000. It just means you take the rest as a profit distribution. Because I've seen so many people say, I know I need to form an S corporation, and then they do it because they make $150,000, and then they're paying themselves $140,000 of it in a salary. They're completely negating the benefits of an S corporation.
Interesting. So what happens if you do it right off the bat? Like, is it harmful to just start it right away? Or are you saying you should wait until you're up to around the 40 to 60,000?
Well, if you do it right off the bat, it doesn't hurt you, other than it costs you about a couple $1,000s a year extra to maintain the corporation versus just operating as a 1099. Because every state's a little different, but you've got extra state tax, filing fees. You've got an extra corporation tax return.
Got it.
Your accountant. You've got to do annual minutes that you can either have your accountant or attorney do. So that ends up being about $2,000 or $3,000 per year.
It's more work and it's more money. So
right. It's actually not more work, because you still have to keep your set of book. You
still have to do that. Yeah.
Work. It's just more money. So we want to make sure that the tax savings from the self-employment tax savings is at least that $3,000 per year. And so that hits around $50,000 to $60,000 of net income. You still get the benefit. There's two other benefits you get of an S corporation that might be worth that extra couple grand a year of filing fees. That is, number one, everyone thinks you get rich one of two ways here in the United States, and that is you either win the lottery or you sue somebody. So by forming the corporation, you're protecting yourself against that second one. It's not going to help you win the lottery. But the other thing it does is S corporations are about 6 times less likely to be audited by the IRS than sole proprietorships. So you've got about a 1 in 40 chance as a sole proprietorship, and it drops to 1 in 250 as an S corporation. And depending on your business and your risk tolerance, that might be worth a couple grand a year of extra tax prep fees in itself. One way to do that is, so to mitigate the cost of an S corporation when you're first starting your business, but still get the liability benefits and still get the potential benefits if the business takes off, is you can form an LLC, because those are cheaper to operate, and it doesn't require an extra tax return if you don't make the S corporation election. And you can actually, once you have the entity in place, the LLC in place, you can retroactively elect to be taxed as an S corporation, even if you have an LLC, as long as you do it within the year of forming. So what do I mean by that as an example? So let's say you start your business in February and you have no idea how this is going to go. Maybe you're going to make $10,000, maybe you're going to make $80,000 in it.
Right.
But you want to have that liability protection. And I'm not an attorney, so talk to your attorney about this part, the liability protection part of it. But you want to have that entity. So you form your LLC on February 1st, and then it ends up, Peter, you don't do that well. You make 10 grand, $20,000. It doesn't make sense to form the S corporation. You just stay as an LLC and you report it on your personal tax return. Let's say it goes gangbusters and you make 120 grand in the first year. And we find that out on November 2nd when we're doing our tax planning. We can make an election and go back to February 1st and save the self-employment taxes on the whole year. So you get to kind of, you get to have your cake and eat it too, in terms of saving the tax, in terms of managing the risk of that first year of business, and you don't know where to go.
Yeah, I love that.
So,
wow.
So that's what I would say in terms of entity selection.
Okay. Yeah, no, that's a really good one. I think a lot of people have no idea about, like, they just hear like, oh, you should form an S corp. And it's like,
Yeah.
all right.
Yeah.
And it's amazing. Most accountants, I mean, don't really talk to you much about that stuff, I feel like, either. It's like, okay, that's what you want to do. Okay, let's set it up.
Yeah, for sure. And it's a situation where the retroactive election, you can't retroactively elect something that doesn't exist. So
Right.
if you're operating as a sole proprietorship and November comes and you made awesome money, if you have that LLC formed, you can go back as early as the formation date. So that's where having the LLC started, it costs, it doesn't cost that much to form the LLC. That's kind of how I would approach that if you're in that early phase.
Mm-hmm. Wow. Love that. Yeah. Okay. And by the way, any topics that you think would be relevant to the audience, feel free to interject, because, I'm just kind of asking ones that I would relate to me. And I think the audience. So, I mean, let's maybe talk about real estate a little bit.
Okay.
I personally own some rental properties that I've had for years, and my personal. So I know a lot of rules have kind of changed recently on that. And I think in the last administration, I don't know if anything's changed back. Could you talk about how that currently stands in terms of if you either have real estate, both rental and personal, and working from home aspect of it as well, or are looking to buy it, and the kind of tax consequences savings that you can take advantage of?
Yeah, so let's start with working from home, because almost everyone that is in a business that can work from home is doing that these days. So the way the home office deduction works is you have to have a portion of your house that's 100% business use. So it's exclusively business. It can't be, I know a lot of people were working off their kitchen tables. That's not a home office. It has to be the room, there's where you're working. And you take the square footage of that room, or if it's the garage, the whole garage, if you're storing inventory out there, you take the square footage of whatever is 100% business use and divide that by the total square footage of the house. And that's your home office business use percentage. And you take that percent and multiply it by all the costs of your home. So if you rent it, so let's say you have a 2,000 square foot house and it's a 200 square foot home office, that's 10%. So then 10% of your rent would be a home office, part of the home office deduction, 10% of your utility bills, 10% of your landscape, 10% of your cable, 10% of, and if you own, it's 10% of your mortgage interest, 10% of your property taxes, and then 10% of the depreciation on your home. That's how that works on the home office. And a lot of accountants will say, they'll talk to I've talked with a bunch of business owners that say, my accountant told me not to do it because it's an audit flag. I personally, and this is just something to be aware of, because everyone's risk tolerance is different. I think my responsibility is to explain the deduction and the strategy, and based on your risk, and this is all strategies, based on your risk tolerance, you decide whether you want to enact it or not. I think the IRS laid off a bunch of people in the last 10 years, and they laid off their auditors. which that's basically like if you ran a company and laying off your sales force, it makes it difficult to continue generating revenue. But it means that auditors are fewer and far between than they used to be back in kind of the old school days. They're starting to tick that up a little bit, but I personally haven't seen the home office deduction flag that many audits. So that's the home office deduction. Real estate in terms of investment properties. One of the big hot button topics is something called the cost segregation study.
Mm-hmm.
And that's when people say buy real estate so you can get a bunch of depreciation, that's usually what they're talking about. And what that is let's say you buy a property. Let's say it's a $1 million piece of real estate. Normally, if it's a residential real estate, you take the building portion, which is about 80% of the purchase price, and depreciate it over 27 and a half years. So
Yep.
800,000 divided by 27 and a half, that's the depreciation you get every year. With a commercial, 39 and a half. Don't ask me why it's a half year, but that's just the way it is. With the cost segregation study, what they do is an engineering team goes in and studies the building, and they break out what is the bones of the building and what's the value of that, and what's the value of the individual fixtures, the toilets, the piping, the countertops, everything that is in there. Right. And they identify the total value of that, and those get broken out as leasehold improvements. And under the current law, leasehold improvements, you can take what's called bonus depreciation, which means you get 100% of it in year one. So if you buy $1 million piece of property and 800,000 of it is the building, normally you're getting, what's that? $25,000 to $30,000 per year in depreciation. So you save 10 grand a year over the next 27 and a half years. If you do a cost segregation study and you carve it out and it turns out 600,000 of that is leasehold improvements, you get 200,000 over the next 27 and a half years and a $600,000 deduction today.
I don't think my accountant, this is on his radar.
Okay. So, and if you're just buying like one-off rental property, like a $200,000 residential rental property, the cost of doing the study usually is prohibitive to the benefit of doing the cost seg. Cost seg is the sort of accounting industry term for it. But it's a great way if you're buying 5 or 6 rental properties at a time, or if you're buying a big commercial property, or when you invest into like real estate funds and to get a big deduction, that's what they're doing in those funds.
Got it. And it's called cost. You have to invest in this. So what does a cost segregation study cost on average?
Usually it's going to be around $5,000 or $6,000 to do the study.
How much?
$5,000 to $6,000.
Got it.
So there's a golden rule in accounting that the cost of whatever you are tracking or whatever you are doing needs to be less than the benefit you're receiving for doing whatever it is you're doing. So we want to look at tax. So if it's going to save you $12,000 to spend $5,000, maybe that's okay. Maybe you want to do it, but if it's going to save you $120,000, then there's a no-brainer.
Well, it's amazing how that principle. I want to focus on that for a second because that's a principle that is just. It sounds so obvious when you say it, but it's like a no-brainer. Like, of course, I would spend the money if it's going to pay off in the long term. But so many people, and I'm sure you see it all the time, their brains just don't work that way, right? We're these creatures of low-hanging fruit, like what's in front of me right now.
Yeah.
And it's like $5-6 grand. No way. It's like, yeah, but you're going to own this property for a certain amount of time and you're going to end up benefiting way more.
Right.
People just seem to miss that one.
Yeah. The big thing is with the cost segregation study is it's essentially accelerating a deduction. So it's essentially a deferral of taxes. And what I mean by that is there's 2 types of tax savings. There's permanent savings and deferring taxes. So permanent savings is you get the deduction now and you never pay it back. So you use the Augusta rule and knock $7,000 of tax-free, of rent deduction. You save $3,000 in taxes. You never pay that back. You get your kids on the payroll. You get $12,000 tax-free per child. You get the deduction. Save $4,000 per kid. You never pay it back. Deferral is you get the deduction now, but you're going to pay it later. So let's say you max out your 401k for $19,500. You're going to get that deduction now so that you have cash in your pocket now to grow it. When you pull the money out in retirement, you're going to pay tax on that money. So all the permanent strategies first, and then the deferral strategies. And so that's where when it's a deferral strategy, you've got to really weigh the cost versus the benefit, and also what are you going to do with that money?
Exactly.
So deferral savings, you don't want to defer $200,000 in taxes and then go buy a Lambo to flex on the gram, right? You want to take that, but if you can take that $200,000 and invest it into something that's going to turn into $1 million over the next 2 years, or even over the next 5-6 years, that's a really good use of the money instead of putting it in Uncle Sam's pocket.
Yeah, I'm taking notes on this. This is good stuff. I like that. So, and wasn't there a rule change under the Trump administration, or maybe it was, I'm a little vague on it, about the amount that you can depreciate or benefit from your rental real estate? I thought it hurt renters more, or was it something with depreciation? I don't know. Do you know what I'm talking about?
So it was that bonus depreciation on the improvements that I was talking about earlier. That was that change. So that's why in the last 3 or 4 years, the cost segregation studies have become so hot, because you get the 100%. So they've always been a thing. Typical depreciation. So every different asset type has a different depreciation life that's required for the IRS. And essentially what depreciation is the length of time it takes for an asset to lose its value. That's the ultimate foundational what depreciation is. So in kind of pre-Trump era new tax reform laws, you got, instead of over 27 and a half years on improvements, you could take them over 15 years. So you're really condensing it. So instead of getting a $10,000 a year production or deduction, you would get a $20,000 a year deduction over underlying production. So, but it sped it up by half. Basically, it doubled your depreciation. The law, why it became red hot, was because you got all of that in the first year. So if you could get all year and then go take that savings and reinvest it into more real estate or more whatever it is, ads to grow your business or people to grow your business, that's why those became so hot.
That makes a lot of sense. Yep. No, thank you for explaining that.
Yeah.
Okay. And then just getting back to you were talking briefly about auditing. So that always has interested me. So a buddy of mine's been audited twice. I've got some people have been audited even more. I've never been audited. You wonder. I mean, is it really a crapshoot, or like this whole flagging thing? Is that a legit thing, where it's like they kind of just leave most people alone unless they see something that kind of triggers them, and then they look a little bit deeper, or is it literally just like a throw a dart at a dartboard and that's the guy you're auditing?
So actually the good news is that it's not throw a dart at a dartboard. So every business, and this is on the business side, on the personal side, they just compare to average. They do the same methodology that I'm going to explain. So every business has what's called a NAICS code, so NAICS. Basically, if it says you're an accounting firm, you're a coaching business, you're a manufacturing company, and you report that on your tax return. And they pull the database when you file, and they compare you against every other tax return that has that code on it. And if you have an outlier expense, particularly on an expense like travel or meals or one of these very auditable types of expenses, that's when you get flagged. So if you've got a $100,000 revenue business, and across the millions of returns that are $100,000 revenue business that in your industry, if the average is $5,000 on meals and you have 4,500 on meals, then you're going to be, then it will be just the luck of the draw if you happen to get called. But if you've got $20,000 on meals, it's not guaranteed that you're going to get an audit, but it certainly increases the likelihood. So that's what's critical to do when you're looking at filing is like our tax prep software actually pulls and flags if there's expense items that are significantly above the IRS average for that, so that you can, sometimes you throw it all off the goods sold, maybe some of it's supplies, you can rearrange where you put the expenses. We're not calling supplies travel. That's a fraudulent reporting of the return. But sometimes travel, or you can have marketing expense versus gifts versus net. There's different places you can put it in, and so moving it around so that it kind of massages the numbers in a way that you're not throwing up flags. Or if you really did spend all that, you can prepare yourself so that you can do two things. You can either roll the dice and say, if I get audited, I've got my documentation, I know it's going to happen. Or if you wanted to be proactive about it, you could actually, if it's an outlier where one year you just were on the road a ton, so your travel's way up and it's going to be a flag, all of your travel log and all of your receipts, and you can attach the PDF of that to your tax return so that when it gets flagged for audit, they actually have someone who looks at it. So that when they pull it up, before they reach out to you, when they pull it up and it gets flagged for audit, you have that support attached there. And that's
interesting. I had no idea you could do that either.
I wouldn't do that. We don't do that on hardly any returns, just because we try to do other ways.
It's almost like raising your hand and being like, "I'm not guilty."
Yeah, exactly.
Kind of, right?
Yeah. Exactly.
Like, are you not guilty? Why have you gone overboard to try to prove such things?
Right. Like there's times there's sometimes where people will go a couple years and have zero accounting records, and they didn't use a separate business account. They were mixing expenses with their personal expenses, and we have no idea what they made. They just got a 1099. But it's not realistic if they're running a business that they should pay tax, because they'll end up getting an IRS notice that they owe tax on that full 1099 amount. So a lot of what we'll do is you just go in, you can create an estimated return, and you estimate based on IRS averages what the expenses should be to be a reasonable number, and then you attach the evidence to the return so that if someone's making 100,000 and in their business, typically they have a 60% profit margin. So they have $40,000 of expenses on that. You attach that support and you file it as a $60,000 net income, so they're paying tax on 60 instead of tax on 100. And in that case, if they're a sole proprietor, that move alone, by doing that, is going to save them roughly $15,000. So
that's really good.
Yeah,
I love that. All right. Well, so is there anything else on real estate you want to mention? I wanted to shift to stocks for a minute and talk about some of the similar type questions with that.
So the investment rule is kind of related to real estate, home office deduction, cost segregation studies. I'd say those are the big ones.
And let's talk stocks. So, well, real quick, actually, with I do have a question. So with real estate, the 1031 exchange, which I'm actually about to be doing. I haven't done too many of them, but I'm about to sell a house in Florida that I own, and then I have I learned I have, I think, 45 days to identify what property I want to buy, and then 160 to actually go through with the purchase, and it has to be of like kind. How strict or non-strict are they with like kind, and could you give some examples of that?
Yeah, so like kind just means it's the same asset class. So if it's residential, you're buying residential real estate. If it's commercial building, you're buying building. It used to be you could 1031 business stocks. So like if you owned a business, you could sell it and then buy a new business. They got rid of that. So basically, it doesn't have to be like you own a $300,000 property, you have to buy another $300,000 property. If you bought it at 150, sold it at 350, and you take that $150,000 gain and use it as a down payment to put 10% down on a $1.5 million property that is still a residential building, that's still like kind. It doesn't have to be similar in condition or similar in cost. One of the biggest benefits is it's sort of like 1031 exchanges is really real life Monopoly, like the game of Monopoly, where you get enough houses and then you buy a hotel. Really, if you can get enough individual rental properties at 100,000 a piece, or other places in Indiana and elsewhere, you can buy a $30,000 rental property that'll cash flow $500 or $600 a month. And then, so if you buy 5, 6, 7 of those, and then suddenly they're worth 50,000, and you sell them all at once, and then go buy $1 million property with debt, and you take the gains on that as a down payment, that you can do. Like, it doesn't have to be same value for same value. You just have to, whatever your gain is, you have to reinvest it to get the deferral.
Otherwise, you're taxed how much?
Whatever you don't reinvest. So if you have
At your regular tax rate.
Yeah, at your regular tax, well, at the capital gains tax rate. So if you have a $100,000 gain and you take 80,000 of that and reinvest it in your new property and keep in pockets of 20,000 of cash, you pay capital gains on the 20.
Got it. Okay. Yep. No, that makes sense. And so, like, what about in terms of like, okay, so it's a single family home rental and you want to buy land that you'll eventually want to build and turn into a rental, but you aren't building yet, type of thing. Like, how does that work?
So actually,
and I'm asking because that's exactly what I'm looking for.
Okay. I think as long as you're buying it with the intention to develop the same type of property, then it's okay. But I'm not 100% sure on that one as far as rolling it into land. It might. Okay. There, I'm not 100% on that one off the top of my head.
Yeah, that would probably be more of an real estate attorney question.
Yeah, or it's just double checking the current code, basically.
Yeah.
The tax code, literally, if we printed it out and I held it in front of me and you stood across the room and fired a Colt 45 Magnum at me,
yeah,
it wouldn't pierce me, like it wouldn't read.
Yeah.
So we like to double check those things.
Well, and speaking of that, just going back to our auditing discussion, it's no wonder that auditors are going, not only are their budgets going down, and they're firing, but I mean, look what's going on in the world today in terms of like specialty trade. It's so hard to find people that have certain specific skills, whereas, in the past it wasn't. And I think a lot of people are shifting kind of the paths that they're taking, and it's becoming a lot more, these, I can work from home and create my own business, do my own thing, whatever it is. Right. Even if you are an accountant and not necessarily or understand. So it's interesting to see how they're going to handle the auditing moving forward. I mean, they got to figure something out. I mean,
yeah, they're calling it the Great Resignation. Everyone's quitting their jobs and starting to,
the Great Resignation.
Yeah.
So it's unbelievable.
Yeah.
I mean, it's insane what's going on in the world.
Exactly why S corporations get audited less, because they require an advanced level audit. Like they got these government bureaucracies where you got to climb the ladder. They require an advanced auditor to audit the S corporation, whereas they don't for the sole proprietorship. And so that's why there's such less audit.
That's I'm writing that down. That's an interesting one. Advanced auditor, and there's already a shortage.
Yeah.
Okay.
One other thing, actually, as we were talking about the 1031 exchanges and depreciation, that I think would be worth mentioning. It catches a lot of people off guard when they sell a rental property for the first time, especially when they've held for a while. So it's a concept called depreciation recapture. And so most people think when I sell my real estate, I pay capital gains on the whole amount or on the gain portion. So you pay capital gains rates, which are more, so like a typical average tax rate, normal ordinary income is about 28, let's call it 28%.
Right.
15% capital gains in that same rate. So, and then the top tax bracket is 20% versus 39%. So 37% right now, it's about to be 39%. So it's a significant savings. So when you have a rental property and take depreciation expense on that property, you get an ordinary income tax deduction on that with that depreciation. So when you go to sell your property, because you got an ordinary deduction, you have to pay ordinary income tax rates up on the amount that you took in depreciation over the life of that you own it. And then whatever is above that is what you pay capital gains tax on. So for instance, let's say you bought a $200,000 property. You took depreciation on it for a few years. You've taken $30,000 of total depreciation.
Yeah.
Sell it for $250,000. A lot of people, so your net gain is $80,000 on that because your book value gain. So a lot of people think that you get the capital gains favorable rate on the full $80,000. It doesn't work like that. So because you got a $30,000 ordinary income deduction on depreciation. You pay ordinary income rates on the first 30, and then you get the favorable capital gains rate on that 50 that is above what you paid for it. That catches a lot of people off guard.
That is really interesting. I had no idea about that. See, this stuff interesting, yet people don't think it is. It's fascinating. All right, so let's switch gears. We're running out of time here. Maybe one last topic here. Just stocks in general. Anything you would recommend now that everybody, Robinhood, everybody's doing stocks, right? And there's probably tons of new investors out there getting into it. What kind of tips would you have for them?
My tip would be whatever you invest, if you're doing it on your own through Robinhood, be comfortable losing it all and basically treat it like you're going to Vegas because it's essentially dignified gambling, if you will, for the wrong people. I can't tell you. So now I only work with business owners, and because there's more I can do for them in terms of tax planning. But when I was early in my career, I was working at a 1040 shop where we just cranked out hundreds of personal tax returns. Every single one. I think there was maybe one in my entire first 4 years of my career. Every single person lost money. Not one person made money buying and selling their own stocks. So, unless they were doing it professionally, and then that's a business and that's a different thing. But so that's what I would caution, that be comfortable that you're essentially playing with house money, and set it aside. So,
or what would you recommend? Sorry to interrupt you, but just buying an index fund.
Yeah, and I would say talk to a financial advisor on that. Index funds. So just to explain what index funds are, you put money into a fund that buys a bunch of stocks. So you're letting someone else, kind of manage that for you. So it mirrors the S&P 500. It would be an S&P index fund. So you're basically America when you put money into an S&P index fund. I won't speak on financial advice just because I'm more of a tax expert than a financial advisor. Just suffice it to say, in my experience, filing a bunch of returns of people investing, day trading, almost every time they lose money. So the big thing on stocks is right now they just passed in the Senate. They just passed this $1.5 trillion infrastructure bill. And in that is a budget provision to grant the House the purse strings to approve another $3.5 trillion spending bill. And most of what Biden's original tax plan provisions were, from what I understand, are included in one of those two bills. We have to pass it to see what's in it. So we're still kind of waiting on that. And the House is reconvening from their summer break on August 23rd, I think it is, to vote on that. So we'll see. But in that tax plan is the original tax plan is the elimination of the favorable capital gains rate for anyone who earns over $1 million a year. So that's not that many people, but it's something to be where that can catch you off guard is you might, kind of on the surface, that sounds like, oh, well, no one's making $1 million. But, if you inherited your grandfather's estate and then held it for 20 years and you're in the Bay Area and you're someone making $50,000, $60,000 a year and suddenly you sell that property and you've made over $1 million and you're planning on that being your nest egg for retirement, now you're paying 40% federal tax on that instead of 20%.
No, that's a very hot topic. They call it the Millionaire Tax. Right. It's a very hot topic depending on which side of the aisle you're on.
Yeah.
For sure.
So that being said, it's coming. I don't know if it's going to pass or not. They're talking about making it retroactive to I think it is.
Yeah, good luck with that. I think that would be a tough one.
Could possibly hold up. But if you've got stocks that you're on and I would never say do something just for tax purposes, because if you sell something and you thought it could make a bunch of money, selling it to save 20% in tax costs you money, right? It's just like you don't buy a car to save taxes. That's like saying, I got to buy it right now. I can't afford not to because it's on sale. You're spending $100 to save $30. It doesn't make sense. Stocks that you're thinking about getting rid of or property you're thinking about getting rid of anyways, now's a good time to consider it just because it could save you a chunk of money. And this is where talking and doing that end of year tax planning before the end of the year, so that you're not just making these decisions by throwing darts on a wall and seeing where it's going to land. You're actually running the case by case scenarios,
Right.
saying, what should I do? And you've got informed decisions with real numbers.
Well, and that also ties into tax harvesting, which I was going to ask about, right? So
next thing I said. So what harvesting loss is, if you let's say you bought into a stock that crushed it this last year, and let's say you made $50,000 on the portion that you bought it, and you've got a bunch of other stocks lost a bunch of money on, and you've got, let's say, $40,000 of total losses sitting there. You can sell the gain stock and sell the lost stock, and you essentially get that money tax free. Normally, when you sell stocks for a loss, your total capital loss in a year can only be $3,000. It carries forward for years to come, but you can only take, so if you lost $100,000 on a stock and sold it because you said, I'm just cutting my losses, you might think you have $100,000 loss coming. You do eventually, but you only can take $3,000 of that per year.
In my brain, I always kind of compute that with sell your losers to offset your winners. And just to make sure that I'm right about this, you have to then wait. You can't do anything. You can't buy 30 days before, and you can't buy 30 days after, right? You have to wait the full amount. And then if you want to buy, and then you get that deduction, like you were saying, like if you made $1 million on a stock, you lost $1 million on a stock, right? In a perfect scenario.
Yeah.
You sell them both, they wash, you haven't touched it, you haven't bought it or sold anything 30 days prior, you don't touch anything 30 days after, then you can actually buy back, and if you like, correct?
Yeah, and that's correct. That's exactly how it works. And those types of transactions, I would always reach out to your CPA and got a financial advisor, your financial advisor, and have them coordinate and quarterback that transaction together. Because you don't screw that up and accidentally have maybe your CPA says, yeah, go ahead and sell it. And so you say sell it, and then your financial advisor buys it back within day 20.
Right.
That. So make sure that you're coordinating those two.
Well, dude, this actually went longer than we normally do because there's a wealth of information, pun intended.
There you go.
So thank you so much, Tyler, for being on. I feel like we could talk for hours and hours and hours. People, if you have questions, where can people find you, use your services?
Yeah, so they can just here on Instagram at Tyler Mcbroom, shoot me a DM. I've got a one-to-many coaching program that I do to kind of give people all this knowledge at an affordable rate that I just launched. So that's a good way to get more, on an ongoing basis access to this. Or if they need help, they can just shoot me a DM. If they want more one-on-one help, then, we can get a call, free call scheduled up. So yeah, that's what I would say if they want to reach out.
Nice, man. Well, thanks again for being on. This was awesome.
Yeah.
I appreciate, I write a lot. I asked questions that I tried to feel like were generic, but also applied to me. So I got some good info out of it as well. So awesome. I appreciate it, man.
Good chatting. Thanks.
All right. Have a good one. Bye-bye.
That's it for the 5 Core Life. If you haven't already, go ahead and hit that like button on this video and pound that subscribe button so you get notified when new episodes drop. Also, please fill out the free 5 Core Life Evaluator quiz. It's a great way to get a baseline of where you are in the 5 cores and which of the 5 cores you need support. In addition, you'll get some actionable advice that you can apply and start improving your life in the areas that you need it most. That's it for today's episode of the 5 Core Life Podcast. Have a wonderful day.
Get moving. Gain momentum. Join the movement. Join Emmett by going to moremomentum.com to take a free life evaluator quiz on where you currently stand in each of your 5 cores.